The next strategy we're going to look at, it's called triangular arbitrage. So what is triangular arbitrage? The definition of a Wikipedia is the act of exploiting an arbitrage opportunity resulting from a pricing discrepancy among three different currencies in the foreign exchange market. Obviously, we're going to be doing this on the cryptocurrency market. It's just that's how it's been used, okay? And when people are talking about it, that's where it's coming from. The thing is, you can't really do it in the foreign exchange market anymore or at all because it's so done on the higher level that there's no opportunity for you to be able to do it. Now, what is arbitrage? Arbitrage is when you're taking something and selling that same thing in a different place for a different price. So when there's a mispricing for the same exact product, okay, there's an arbitrage opportunity, okay? If you find an apple in one place and you can sell it the same apple in another place, there's arbitrage that can be done because since it's the same apple, it should be at the same price. You can do arbitrage in plenty of markets, different markets, right? You can do arbitrage in stocks between exchanges, between currencies. For example, RBC, one of the biggest bank in Canada, also trades in the United States on US dollars. So you can look at the price when it's trading on the TSX and on the New York Stock Exchange and see, well, if there's a mispricing based, including the currency conversion, where you can buy it on this exchange, can then sell it on the other exchange, convert your money back, and you make a profit. This is arbitrage. Now, this strategy is definitely not for everybody. So if the market making strategy wasn't for you, this is not for you at all. But, I highly recommend, listening to these lectures because even if you're not doing the strategies, I'm going to talk about some things that might open some ways of thinking for you, even for other strategies that you're doing. So this is a strategy where you need to be, in front of your computer. It's a quick strategy. It can also be automated. Don't worry. The next strategies that are coming up are longer term strategies. These ones are very quick strategies. The other ones that we're looking at are longer term. So I've made strategies here that will appeal to different types of people. Shorter term, or even people who want to automate something, to people who want to do things that are longer term. So don't worry. But still there is benefit in listening to what the strategy is. Okay. So how do you do triangular arbitrage? So I took the prices from Key because this is what we were talking about. This is the coin we were talking about when we were talking about market making. And this is how you do it. You look at Key versus Bitcoin. You look at the coin with Bitcoin first because this is the one that's going to have the biggest spread. And then you look at Key with another currency. It could be Key Ethereum, Key USDT, whatever. But you look at another one. And then you see if there's a discrepancy in prices. So in this case, if I'm looking at this currency pair, I'm saying, okay, well, you know what? I'm going to try and buy Key on the bid. So I have Bitcoins in my account, right? I'm starting with Bitcoins. I have whatever Bitcoins. And what I'm going to do is I'm going to try and buy Key. So I place an order to buy. And let's say for this example, I'm buying 1 million keys. They're very cheap, right? Because they're trading at 14 Satoshis. So 1 million keys will cost me this amount of money. And we can calculate all of this here. So you see the calculation up here. So I can see that 1 million keys at 14 Satoshis. So that's 6 zeros, 1-4, is going to cost me 0.14 Bitcoins. So you can see here, buying 1 million keys at this price will cost me 0.14 Bitcoins. Now, as soon as I buy them, what I'll do, and I took these prices from live, so we'll go and look at the prices live so you can see that they concur. But just before doing this lecture, I took these prices from Binance. Now, I'm looking at Key and I see that the bid ask is this. The keys that I bought with Bitcoin, I turn around and I try to sell them right away on the bid here. So I get Ethereum, right? So I used Bitcoin to buy Key. Then I'm going to sell Key to get Ethereum. Now I have 1 million keys. So 1 million keys that I'm selling at the bid is going to give me 0.12. Oops, sorry. So 1 million keys. There we go, 1 million that I'm selling at the bid. 1, 2, 3, 789 is going to give me back 7.89 Ethereums. Okay, so here, a million keys sold at this price gives me 7.89 Ethereums. Now, what I'll do is I'll take back these Ethereums, and then I want to get back Bitcoin. So I sell Ethereum for Bitcoin at this price. And if I sell those 7 Ethereums at the current bid, which is 0.018657, I'm getting back 0.147. Let's see here. Oops. So there's a little typo here. Here it should have said 7.89. Okay, so here, little mistake. I'll change it so if you have downloaded the PowerPoint from the first lectures, it will say the right amount, which is 7.89. So if you're selling 7.89 Ethereums at this current price, right, you will get 0.1472. which is this amount, right? So I started off by using 0.14 Bitcoins, and I ended up with 14.7 Bitcoins. So I've made 0.007 Bitcoins. Or, because you want to talk in percentage, because you don't know if you're trading with more Bitcoins or less Bitcoins, or in percentage, 5.14%. So I've made 5.14% on a very, easy, well, not that easy, but I mean, very simple trade with less risk. That's what I want to say. So basically what I'm doing is I'm looking at key to Bitcoin and I'm saying, hey, key to Bitcoin is at this price. If I can buy here and then I convert my keys to Ethereum and then I convert my Ethereum back to Bitcoin, I can end up with more Bitcoins, right? It's as simple as that. I started with a currency, in this case, Bitcoin. I buy something else, key, convert key to Ethereum, convert Ethereum back to Bitcoin, and I ended up with a little bit more Bitcoin. So then I made profit, and then I restart, and And this is why it's called triangular arbitrage, because you're arbing a currency by doing street transactions, okay? Now, why does this work? Well, it works for a simple reason, okay? Because you have, let's say, one currency like key BTC, okay? Sorry for my writing. Key BTC that has a very big spread, right? The bid here is at 14 Satoshis and the ask is at 15 Satoshis, right? So here there's a big difference here. And what's the difference? Let me calculate it real quick. It's 7, I think, right? 15 divided by 14, 7%. So there's a 7% spread, okay? Now, you might look at then another currency like key Ethereum. And the spread for key Ethereum is going to be different. Look at the spread here. 796 divided by 789. Oops, sorry. 796 divided by 789 gives us 0.8%. So the spread is way smaller. Okay, let's see here. The spread for key Ethereum between the bid and ask is way smaller. So when you have a same currency that's trading versus another currency and the spread is different, well, if you're buying here on the bids, what you can do instead, once you get the position, is go on another currency and sell it aggressively right away to somebody on the bid to get this other currency that its value versus your initial Bitcoin currency is high, right? So whenever you have two currency, the same currency trading on a different base currency, okay, that have different spreads, there's going to be an arbitrage opportunity. Because if you're able to buy where the bigger spread is, take that currency, sell it where the smaller spread is, and then convert back the currency you get to your initial currency, you're going to make money. Now, sometimes, this other currency, the spread is somewhere here, which you'll make more money. Sometimes it's somewhere here. In this case, you're not going to make as much money because you're buying here, selling here. It's very small. So this is why it works, right? And we can do this on any currency. And we can also do it, on this one. So let's take a look at something else. Let's choose a coin randomly. So we can go to coin market cap. Let's go on exchanges and go in Binance. Let's find another cheap coin and see if we can, let's select Bitcoin and see if we can find one and do the calculation in live. Storm, I don't know too much about this one. Storm, let's check out Storm. Let's check first Storm. Well, let's see if it trades on something else like Ethereum. Okay, so it trades on both. Let's check it out on Bitcoin. So Storm, yeah, in the same range. Okay, so let's do Storm BTC, and then we need to open another chart for Storm. Let's do Ethereum, and then let's have another chart with Ethereum back to Bitcoin. Ethereum back to Bitcoin. So if I place an order to buy here, and let's say I'm buying for, how much is this? This is trading at 50. Let's keep the example with $1 million to keep it simple, because $1 million of that isn't even that expensive. It's such a cheap coin. Okay, so $1 million, right? So you go $1 million times the price you're going to be buying at. So you place an order at the bid and you wait until you get filled. So 0.12345 15. This is how much it costs you, right? And you have $1 million and it costs you 15. So then you go on the Storm Ethereum and you sell back those million coins. Now, if you'll see here that you're going to have a hard time to sell $1 million. Okay, but let's say, okay, so let's say for this example, we did 500,000, okay, instead of $1 million. So 500,000, it would cost half of that, so 7.5. Now you're going to be able to sell the 500,000 at this price, because here there's not enough people, and you want to sell it right away. So if you sell 500,000 at 0.0000837, you are getting this much Ethereum. Okay, you're actually going to get a better price because there's these prices here, so you're going to get partial filled here and then get the rest at this price. You're getting this much Ethereum. You go back to Ethereum and you sell your Ethereum so you can convert it back to Bitcoin, and that's pretty easy. For Ethereums, you'll be able to get all of this executed here. So 18,582. So times 0.018582, you get this much Bitcoins. And we said in the beginning, since we used half, it wasn't 15, it was 7.5. And your initial cost was 7.5, so 0.75. So you made, so 0.075. That was your initial cost, and you ended up making, how much did we say? 7776567 minus 0.075. So you made this much divided by 0.075. So you made 3.6% return on that trade. Okay. So different coins are going to give you different values. You can test different ones. If you do something else like Dent or one of these other coins that we saw, Win, or some of these ones that had huge spreads, the probability the profit is probably going to be higher. But this is what triangular arbitrage is. Now, triangular arbitrage can be done on any pair. So you don't have to necessarily do it on Ethereum pairs. You could do your coin, let's XYZ Bitcoin, and then once you get XYZ, you don't sell it to Ethereum, you sell it directly to USDT. And then once you sold it to the USDT, then you can convert back your USDT to Bitcoin. So it could be any triangle, right? Now, which triangle you should choose, it depends. Depends on the order book. Because like we've looked here, when I did 1 million coins of Storm, I would have had a hard time selling 1 million coins on this order book. Or no, actually I could have sold 1 million, not a problem. But imagine I want to trade bigger and bigger. Well, this order book isn't that thick. Some other order books are thick, and some other order books are thinner. So the second coin that you're going to be trading, you want to make sure that there's enough people on the order book. Okay, so this is going to be something that you want to make sure, right? this order book, there has to be enough people because you're going to be selling aggressively on the bid. So you want to make sure there's enough people on that order book, right? Now, another thing for this strategy is that this is a better strategy for somebody who's very quick on the computer, because you have to be extremely quick, and it's a very good strategy if you want to automate. So if you do any automation, if you do any coding and you want to program this strategy, there's some companies who the only thing they do is triangular arbitrage. Like, this is something that's done, okay? And they're good at it because there's so many things that you can implement. You can implement, codes that will look at the order book and see the speed at which something is being filled. If there is higher volume than usual, you can, cancel orders quickly. You can execute your trades very quickly. You can co-locate the strategy near an exchange to be faster. You can do so much. Like, you can spend your life working on this, right? So this is a strategy that, would cater to somebody like that. Now, coin selection is pretty simple. You want cheap coins. It's like the market making strategy. You want cheap coins because they have bigger spreads. You want high volume coins because you want to be able to get in and get out big amounts, and you want to be able to do that quickly. And you want things that aren't too volatile, because if it's very volatile, by the time you get into one and you go to get into the other, it might have moved by a lot. And position sizing, the way I do this is just simple entry, right? So you don't scale in or anything like that. Now, some things I did not include here are the fees. Well, if I'm trading on Binance and I'm buying here, I have 0.1% fees, selling here 0.1% fees, selling here again 0.1% fees. So that's 0.3% fees, which will reduce this. So from 4.15, it'll go to 4.84, right? So we're losing 0.3%. So you have to factor that in, because with all these trades, it will, it will be a factor. Now, the other thing is, if you buy on the bid, but the prices are really dropping fast, then what's going to happen is this pair here is probably going to be lower as well. It's probably going to have dropped as well. So you might not get the exact prices that you thought you would have get by looking at it like that, okay? And especially if you buy and other people are buying, maybe other people who bought are also doing triangular arbitrage. So they're selling here and the price of this one is dropping quickly, so you have to be fast, right? So there's all these factors that go into it. So for you, if you want to try it, make sure to try it with a very small amount of money to see if you're able to do it correctly. If you want to automate it, same thing. Make sure you're doing it with a very small amount to make sure that it's working correctly. And I think that's enough for this lecture. I want to talk a little bit more about this strategy to give some more insights, and I'll do that in the next lecture. So see you guys there.